Hello and welcome. I'm Patrick Curtis, your host and chief monkey, and this is the Wall Street Oasis podcast. Join me as I talk to some of the community's most successful and inspirational members to gain valuable insight into different career paths and life in general. Let's get to it. In part 2, we pick up from part 1 and learn how WS is able to make an internal transition at his Bulge Bracket bank to get even closer to the actual trading, eventually becoming vice president on the high yield credit desk before another sudden turn of events would leave him out of the job for 6 months. Find out how he ended up at an even better Bulge Bracket after a half-year hiatus, but this time in a research capacity, and why he left after less than 2 years to finally join a hedge fund putting his ideas to work. Enjoy.
So, in my lunch breaks, I go down, I let myself onto the trading floor, and I basically cornered him and asked him, hey, look, I'm really interested in the group. Can you tell me more about it? Basically went down, got said no a couple of times. There were a couple of times where he actually sat me down, talked to me for 5-10 minutes, had to go back. But I kept this up for the better part of, call it 6 months, right? And I was that squeaky wheel that went in. I sent emails. I followed up with
Why, before we even go there, so I love the story of the hustle, but tell me, how did you know this was a good place to be for you?
Because internally, through my current role at the time, one of my friends, one of the guys who worked in the internal credit department, who I came to become really good friends with.
Yeah.
He was telling me this guy's an all-star. Go down and talk to him, right? He very well known. He covers the space, and he's I rated number 1, multiple years.
Yeah.
If you want a true investing role, this is the guy you need to talk to. And so, look, I trusted this guy, and I told him, look, I will do anything that I can. And so, he told me, look, he can make an introduction, but it's better if I just go myself and just show how hungry, because that's how he is, right? People on the desk are eat what you kill, right? Yeah. Eat what you kill. You go chase, you go hustle, be aggressive. They like that kind of personality. So that's what I did. And 6 months, it took me 6 months of just emails and talking and conversation. And then one day I heard, oh, this guy's leaving the bank. I'm like, oh my God, I just, my only contact there is gone. But then I get an email from him later that day, and he said, he had copied me in what was to be the next head of the group. And he said, hey, look, this guy's been keeping in touch with me over the last 6 months. He's really hungry. We're looking to hire a couple more people because we're building out the team. Talk to this guy first because he's shown the most interest. So it paid off, right? Yeah. The IRR on 6 months, yeah, that was pretty damn good.
Pretty damn good.
Yeah, it's pretty damn good in my opinion. So,
at that point, the leverage loan structuring stuff, that's more of that was kind of more of a front office gig, right? Considered
it was considered kind of front office, because it depended on, because the fees that you generated were your underwriting fees, right?
Right.
Whether it's committed or if.
But you were making a lot more than your first go around.
Oh yeah.
You were making what, 140 or 30 all in, or 160?
But this was
a while. I know this is still bad bonuses coming out of it.
Yeah. I was probably making about 130, 140 all in, I think.
Oh, great. Okay.
Yeah. So, and I was an associate at the time, and but the thing is, it was considered a front office role, but it wasn't paid like a front office role, because the fees for underwriting these loans went to capital markets. Leverage finance capital markets was an actual separate group.
Got it.
And so they pocketed, the 2.5% fees on, the bonds and the loans. We, got a sort of cut of that, just because we helped out with the structuring and the legalese and all that kind of stuff. So
right.
It was more front office in nature. Yeah, it was kind of front office. So I knew I wasn't entirely there.
Yeah. So was this next place front office?
This next place, still at the same firm.
Yeah.
Was definitely front office. So I was a desk analyst. Eventually got the job because I interviewed. I got put sort of through the meat grinder, and through multiple rounds, meeting people, case studies, everything, just to make sure, because I still had a pretty unconventional background, right?
Yeah.
Musician, you were instruction, you did leverage finance for about a year, but have you ever been on a trading floor before? Right. So
this is you trying to get closer to actually making investment decisions.
Yeah.
Or at the very, not necessarily controlling P&L, but at least giving advice on the markets or on a specific market.
Correct.
Okay.
Yeah. So as a desk analyst, again, I mean, this is post GFC. And so.
Yeah. For the listeners to understand, like, what this meant, it'd be great to, can you tell, what does a desk analyst do? Yeah.
Yeah. So a desk analyst, essentially, you are typically broken up into different industries or by situation. So at this particular bank, you have a team of, call it 10, 15 people. There were pods and silos covering different industries. And your job was to essentially know every single name in that industry.
Mm-hmm.
You were expected to have a working model. You were expected to, have regular conversations with management, and also have sort of synthesizing all this information. You had to propose trade ideas, right? And you were the source of information for a lot of buy-side folks. You were their point of contact in that if somebody on the buy-side, such as a hedge fund, they wanted to get up to speed really quickly on a name, they would call up their sell-side counterpart, which is usually a desk analyst, and they would say, hey, I'm looking at company XYZ. Your sales guy told me that you covered this name. Can you run me through the situation? Can you run me through some of the high-level numbers? And it's your job to be able to have that at your fingertips and be able to do that, because that's how you establish relationship. That's how you get the client to trade through your trader, and that's revenue for the firm, right? And so you had to be the first line of defense. You had to be the first line of information for your clients, and these are really big clients. It's like Lord Abbott, BlackRock, Oak Tree, Aurelius. You better know what you're talking about. And so when I first started, obviously I was not having those conversations. I was shadowing my boss, who was the head of the group at the time. He hired me. I was on every single phone call he was on with clients. So, my job at the time was to get up the learning curve. And what that meant was, look, you got to learn two different sectors. You have to learn industrials and you have to learn metals and mining, right? And, this is right around when commodities crashed in 2015, right? When Freeport bonds went from par to 30 cents, right? So, I mean, that is one of the major copper producers in the world. And you saw overnight copper, prices tank. You saw iron ore prices tank. All the metals and mining names in the space basically tank. But to answer your question kind of full circle, the desk analyst is responsible for understanding the industry, understanding the trends within that industry, and also understanding specific metrics for relevant top of mind names, right? So if you're covering tech, you would need to know, NVIDIA. If you cover media, you would need to know AOL, Time Warner at the time, right? So on. You had to be the point of contact for the buy side.
Really interesting. Okay, so you get this dream job. You're getting closer. You're sitting in all these phone calls. How fast are you getting up the learning curve? Or was it like, oh my gosh, what did I get myself into? Because there's such chaos given the time.
Well, you've seen that picture of the dog, right, sitting in the fire. This is Fine Dog, yeah.
Fine.
This is Fine Dog, yeah. It was like that for about 6 months, and it really was a fire drill, because that's the first time you learn, and it's a scary process. But this is the first time you learn what earnings seasons entails, right? And so when you're in an investing role that is live with the market, mm-hmm. earnings become incredibly important, because your trader is trading on information that is really relevant for that particular company or competitors within that space. And so your job, in addition to being on top of all your names and modeling and understanding and learning about the industry, you had to be essentially a news jockey. Your job was to pay attention to every single headline that could be material to your name or the competitors' names or affected the space. And it is your job to let the trader know, because there's nothing more scary than a trader getting picked off because they didn't know the information, right? And so what I mean by picked off, for those you probably don't know, is let's just say that Google reported some headline that said, they experienced a massive cyber hack and, half of their database got hacked and compromised. And your trader owns a bunch of, Google bonds. And so if the market is as efficient as it is, and it's pretty efficient, there will be traders who are going to be selling, right, the bonds on this news because it's a negative headline.
Right.
And if you're not aware of that piece of news and you told your trader, I like Google, your trader is going to suddenly see, oh, these bonds are now being offered 5 points lower. Oh, that's a steal. I'm going to buy this. They step in front of that train. They get completely crushed because they didn't know this piece of news, or something really positive happened on the flip side. They sold a bond that they should have held on to, right? They get picked off by the market. There's nothing more scary than a really angry trader coming at you because you didn't follow or be aware of the news, right? And so that was the fun and the scary part of the role. I mean, you actually saw and you had a finger on a pulse of the market every single day, right? And it's not just stuff that was going on in your space or your names. It was the market itself, right?
Because you had to be looking at headlines and thinking, is that gonna hurt or help?
Exactly.
Any of my names.
Yeah. And what you learn really quickly is that just dropping a headline into a chat room is not enough. What you needed to learn quickly and do well is, what is the news? Digest it. What does it mean? And then lastly, the most important part is, what does this do to our position, right?
Mm-hmm.
You have to figure out really quickly, is it positive or negative news? And if it's positive or negative news, what should you do, right? Ignore it, buy the dip or buy the fall, right? The drop, or should we sell, right? Get out, right? And so, but the thinking is that before the trader ever puts on the position, you thought of theoretically all these scenarios and all these risks. And if they happen, you have a contingency plan in place.
So were you just on the phone all the time, with traders, all day?
Well, my trader sat, 2 rows behind me.
So you're just right there. He's screaming at you. You're telling him
he's screaming at me. Well, at the time he's screaming at my boss because he was handling all the calls. But as you get more into the role and you understood, there's a subtlety in terms of the news release, right? A news isn't binary. It's 10 bad or 0 good, right?
Yeah.
It's it could be a 7 on a scale of bad or a 2 on a scale of bad. And then your job is to say, okay, I've digested and processed this news. This means, bonds are going to widen by 20, quarter basis points, right? 25 basis points or 50 basis points, or it's going to gap out to 200 basis points. For some reason, you have to be able to communicate the news in a way that the trader is going to understand.
And so the trader's trading, it sounds like flow, and you're trying to give them a heads up of how wide they need to make their bids not to get lose money.
Yeah, exactly. Yeah. You're basically, you're telling them
how crazy is this news? How uncertain is this?
Yeah. You tell them the severity of the news, whether it's positive or negative.
Yeah.
It's their job to manage the risk, right? Because post greater financial crisis, we all know that prop trading went away, supposedly, right? It's going away, but your job as a broker dealer is that you're creating liquidity for the market, right? And so you're buying and selling constantly, and your trader cannot get caught off sides because they don't understand the risk or what's going on fully with that name.
Yeah.
And so it's just so important for you to really know each name and know the drivers and know when a piece of news comes out that first person you have to tell is the trader, right? So that got beat into submission into me the first couple of weeks. Do not miss news. And I've seen it play out really badly with other people. So, but it, to a lot of people, it's really scary, right? But I loved it. I loved how crazy it was. People shouting at each other. It is hard to concentrate on a trading floor because the sales guys are always on phone calls all day.
Yeah.
The traders are throwing a football. Sometimes they'll hit you. And you're there in this massive, just chaos, massive chaos and mayhem. And you're trying to read a 10Q or a 10K, and you end up reading the same line 10 times because you can't stop focusing on the guy behind you, the sales guy talking about his night out at at Tao, right? I've read this line 10 times. I have no idea. So you give up, you kind of just manage your workload. And after the market shuts down at 4 o'clock, you're like, okay, now I'm going to get to sort of the work I actually was supposed to do during the day.
Yeah.
But I think in this role, it's really important to understand that this is where I really formed my love and appreciation for credit, right? I know that equity markets are exciting. They have obviously juicier returns than credit, but within high yield and distressed, it had very equity-like characteristics, but it had a very set parameter in which these instruments function, right? And so your risk is theoretically capped at, for the tenor of the instrument, right? It's nice to know that in 5 years I'm going to get paid back with interest, or I'm going to have a donut at the end of the day, right?
Yeah.
Whereas for equity, it's like you have to consistently always be a perma bull, and you have to believe in this company, and that stock has no duration. It goes on forever until it goes bankrupt.
Right.
For credit, I love the parameters. I love the legalese that binds us. And I think with my previous position and the desk analyst job, this is where I started to figure out, this is a really cool space to be in. High yield, distress,
Yeah, you were there for a while.
And this is where I ultimately found a home, and I loved it. And unfortunately, at the time, there was a CEO change, and like half the people in my group got laid off. They called it reduction in force, and so I was unfortunate. At the time, I just had gotten promoted to VP.
Yeah.
I'd never gotten laid off before in my life, and I was like, oh man, this sucks. And then there was like a 6-month gap where I was like, I could have easily gone back to something, but I took 6 months off, and I traveled around the world. I was like, I built enough savings, and I'll tell you that summer was probably, I'll go and, at the end of my life, I'll say that's probably one of the top 5 things I did in my life. It was probably one of the most fun things I'd done.
Those 6 months, meaning just traveling. Where did you go?
I went all around Europe.
Yeah.
Pretty much like England, France, Germany, Italy, Poland, Hungary, Serbia, Lithuania, Sweden, Finland. Wow. Yeah, I went through all that. And then I did Asia for a bit. And it was an incredible time because up until that point, I had not really taken a vacation. So probably it was like 5 years since it was about 7 years, and I had not really taken a vacation because I'd been job to job and really just trying to build my brand and my skills. And it was a nice sigh of relief at the time. I knew after 6 months when I came back, I had to explain that. And there was no way that you can like talk yourself out of taking 6 months off, right? So I don't remember what I said, but
well, probably I didn't have a vacation for 7 years. I was resetting.
Yeah, well, I was resetting, and I think it was probably another version of like, hey, I want to work at your company, but ultimately I was able to come back from the trip, and there was a lot of life reflection on the way, but I think ultimately what I thought was, look, I'm really interested in credit. I really love this product. And I think it's going to be around for a while because there are always going to be companies that need capital. There will always be companies that have a good business model, but a terrible balance sheet, and they need help, right?
Yeah.
And so I think, I was ready to come back after 6 months. The next job was I don't know if it was like a transition job or it was just the brand name. It was another Bulge Bracket firm. Mm-hmm. I became a publishing analyst, and it was good in the sense that I understood a different sector, but ultimately I knew that I had taken a step away from the P&L, right? I was a publishing analyst.
Credit research, basically credit research.
Correct, yeah. And I wasn't close to the P&L anymore, right? And so there was a separate desk analyst group at the firm, and I knew, having been in the role, that they're the ones talking to most of the investors. They're the ones who saw the flow, and you're really just there to write your thoughts on a piece of paper. Again, I'm not trivializing the practice. I knew it wasn't for me.
Yeah.
But
you did it. Was it because good brand, Bulge Bracket name, and because it just you didn't have other options coming back from that long sabbatical, we'll call it?
No, I actually had like 2 other opportunities at the time. I ultimately went with this one because it was a good name, and there were good people who worked in the group who ultimately after 6 months, a lot of them left. But I got really good at writing at this point, right? And so the one thing, if I had to gripe about one thing, it was the amount of time that passed between the formation and the idea and then putting the risk on. Because with any publishing role, you have to go through spot checks, you have to go through compliance, you have to go through like publishing, and there's a whole period of that, right? Like there would be 1 or 2 days lag between, you know, when you submitted it for publishing until it got published. And so, and then like, you know, walk that back maybe 2 or 3 weeks when you start looking at a name, do work. It's a very long process. And by the time you get to the end, maybe the trade's gone, right? And so I knew again that I love the approach of putting risk on. You did work, you were iterative on the desk as a desk analyst. You put the risk on, get kicked around it for a little bit and understand how it traded. And as you continue to underwrite and refine your theses, you can either sell out of it or you scaled up, right?
Yeah.
Whereas in a publishing role, it was just like, oh man, this is a long process. I feel so further removed from what I really like doing, which is, you know, markets and
why didn't you go back to like a similar desk? It sounds like you had found was it just, hey, I'm going to try this new thing. I want to become a good writer and there's good people working at this place?
Yeah. I mean, it was really the brand. And it was, I mean, to your point, it was, you know, 6 months and, you know, you kind of have to get into the swing of things again. And I covered a really cool sector. At the time it was blowing up because, you know, everything in the space basically started trading like it was the distressed asset. And so, you know, I had covered metals and mining in 2015 and 2016. This particular sector also imploded. And it started to get me expanding into distressed investing, talking about valuations, thinking about bankruptcies. And that, I think, was an experience I was really thankful for, because the next role allowed me to really start to exercise some of these skills that I've accumulated along the way.
Yeah.
I knew that ultimately what ultimately led me to leave the sell side was you don't really take risk at a sell side bank, right? Because of risk requirements. It's not your job to do that. Your job is to be the aggregator of information and then preserve and build relationship with your clients. So I knew the only way that you can actually put your money where your mouth is actually to go and work at a hedge fund, transition to the buy side. And at the time, there was a really cool opportunity that came up and I took it. Small hedge fund. I had been at large institutions for a very long time. I didn't want to, you know, kind of jump through all the red tape again, all the bureaucracy. I wanted to find a name, find an idea, do enough work. Let's put it on and let's see if it goes up or down, right? And so, it was a really cool group. I learned a lot. I was able to put my modeling, my legalese, my trading, all those things that I have synthesized over the years, really for the first time into practice. And I'm thankful again.
How did it feel?
It was exciting, but
scary or fun?
Look, again, the This Is Fine dog came around again. And I was like, well, this is my first time in the space and, you know, I've never been on the buy side, but, I quickly realized that this is where I wanted to be, right? If you gain conviction, and this is something that I don't know if folks are familiar with, but conviction is something that you'll probably hear a lot in the business, is that you come up with an idea, you iterate, reiterate, iterate, underwrite, go through the risks. You get to a point where you know that you can size this position up to 10%, 15%, where it's a material position within your firm.
Yeah.
Conviction is that you have the confidence in the net amount of work that you've done to be able to take this level of risk, right? And so when we talk to folks on the buy side or the sell side, oftentimes we will ask them, like, what's your conviction level for this, right? And a lot of people will say, well, my conviction is, 6 out of 10, because X, Y, and Z variables, I have no idea how to underwrite. I have no information on this. So they'll say, okay, this is kind of like a yo bet, or this is something I have a lot of conviction in because I've looked into all these other supplementary data points to support my view. And that goes a long way, right? And so when you start to, develop this muscle memory, when you start to educate the street on some of your own ideas, on your conviction level, and as long as these ideas, more of them work out than don't, then you really start to build up this really good network of buy side guys that you talk to, that you can trade ideas with. You can get like first dibs on ideas. That is the networking, the Rolodex that you build over your career. And so, at the shop, I was able to really, put my money where my mouth is. I love modeling. I think that is the only thing that I can hang my hat on.
Can you explain like the types of trades you're putting on? So like, let's say there's a distressed retailer, and you're like, hey, I'm going to buy the senior debt. I'm going to sell a sub, or vice versa, because X, Y, Z. And like, so you were modeling out like the cash flows and the whatever, all that stuff. How are you doing this?
So there was a retailer that I was looking at during this apocalypse period, and they had 5 different business segments. So it's a retailer that have 5 different clothing lines.
Yep.
It's like a men's, there's a women's, there's a children's, and retail is notoriously hard to value because it's not a factory that's producing widgets, right? It's like a piece of clothing that could go out of style tomorrow, right?
Yeah.
So the value of that actually is very, very hard to actually pinpoint. But what I love to do is there are many different ways that you arrive at valuation. Sort of the lazy way that a lot of people on the street that I found were doing was simply trying to figure out what a future EBITDA was, or stable EBITDA was going to be, slapping a multiple range on it and just saying, hey, look, this business is worth anywhere from a couple $100 million to whatever billion, right? And that kind of approach, sometimes it works. It works sometimes. But that can really get you into trouble when things start selling off, the market goes
distressed, when you're looking at distressed credit. Yeah, especially.
Right. Because the multiples work until they don't, right? Multiples contract, they change.
Why is it trading at 2x EBITDA?
Well, it's like, this was supposed to be a 6x business. Now it's trading at 2x. Like, and then when you don't have the work to back it up, suddenly you're like, oh God, what is my valuation based on, right?
Yeah.
And you don't want to tell your PM, oh, it was just a valuation. But what I did was, I modeled out historically, and I love to take, if these companies went back to the greater financial crisis, I modeled them all the way back to 2009. I know that's super draconian. People don't do that often, but I want to look at how they weather very historical periods of stress.
Yeah.
Right. 2009 was something special. You saw a massive inflationary period in 2011. You saw the commodity crisis in 2015. You saw the taper tantrum in 2018. Right. You look at how some of these things traded. And so I had to. I'm a very visual person, so I need to have a working model in front of me, and I build fast, right? After years of just playing around with Excel, I got really good at building models really quickly, right? 3-statement models, LBO, valuation, waterfalls, all that kind of stuff.
Yeah.
So for this particular retail name, I broke it down into all the different segments. I figured out the cash flows for every single one of these segments. The one key thing that I had to determine was, this is a retailer that was losing market share. And so it had declining sales, it had declining EBITDA, it had, ballooning expenses. And so, it's a melting ice cube for all intents and purposes. And so you have to figure out what is going to be the stable state of this melting ice cube, right? Because it's not going to melt forever. Yeah. It's like saying, if you're trying to buy a newspaper company, newspapers aren't going to go away. They're going to shrink to a sort of a smaller level. It's going to be much smaller than it is today, but they're not going to go away, right? People will still enjoy reading newspapers.
At least not for a long, long time.
Not for a long, long time. It's a very, very long tail, but you have to have an idea of like, how bad can it actually get? Mm-hmm. And so, there's the valuation approach where you're slapping a multiple on it. You're looking at other different retail companies in the space, right? So you're looking at apparel, like women's apparel, children's apparel. You're looking at their margins. You're looking at their top line growth. You're looking at the unlevered free cash flow, levered free cash flow yields, looking at market cap if they're public, like looking at if their capital cap structure is upside down. And then you figure out sort of the RAL values, like, okay, where does this particular name slot against everybody else, right? On a leverage free cash flow basis, on a valuation perspective, on a leverage debt to cap ratio, like all these different things. And you say, okay, crappy business, lower margins, upside down capital structure, names in the space are trading 5 to 6 times. This is probably a 3 to 4 times, right?
Yeah.
But then you always have to haircut even more that, because, when something goes to stress or they go bankrupt, multiples or prices will trade passive where you usually think they will, right? It's not enough to say if this thing goes bankrupt, and I've done the valuation and the waterfall, this bond should trade at 40. I will bet you 99 times out of 100 that bonds trades past 40 into the 30s and 20s, and it bounces back up, right? That's just how things work.
Yeah.
Because there's a real fear when everybody's piling out the door trying to sell it, right? They will oversell.
It's going to go to the pennies in the dollar, and
yeah. And then it's like the marginal buyer, like the support level, are the hedge funds, the guys who've done the work and say, well, this is completely oversold. I know this is worth 40 cents. Yeah. It's a bargain. I can 2x my money, buy it at 20.
And I can lever it up.
Yeah, then you can lever it up and you can carve it off as you want. So yeah. I mean, like going back to the retail example, I had to figure out every single, number one, figure out the space. I had to understand basically the operating metrics and the valuation metrics for every single one of these companies. And then I had to look at a cash flow. So you did DCF, get it, garbage in, garbage out, but you have to have a method to the madness, right?
Yeah.
DCF, you have to look at free cash flow. You have to look at relative, rel-val. Are there better plays out there, right? This is cheap, but is there something cheaper in the market, right? Right, on a yield to maturity or yield to call or yield to worst basis. So, as part of that analysis, I had to go through all the different legal documents, credit agreements, indentures for all the various parts and instruments in the capital structure, looking at RP capacity, looking at secure capacity, debt capacity. So in these scenarios, once you've read all the information, you've spread all the numbers, you've looked at all the competitors, the scenarios that you underwrite are essentially, if this thing went bankrupt, what tips it into bankruptcy, right? Like, what is this liquidity? How much is drawn under the revolver? How much availability does it have left, right? And if they're burning cash, how many months or quarters do they have until their cash runs out, right? And so once you get a sense of what that runway looks like, then you look at the different instruments within the capital structure and you say, okay, liquidity runs out in 6 months. This instrument has a maturity that is in 2 years, and like, then you have to ask yourself, is this instrument secure at the top of the capital structure or is it junior, right? You have to get a sense of, like, you have to get a bearing of where you are, a sense of where you are in the capital structure. So once you have all this planned out, then you have to look at the documents. You have to look at secure debt capacity. You have to look at RP capacity. You have to look at trapdoors, meaning if the company wanted to siphon value out from one of the segments and then dividend it back to management, if the documents allow it, they may do it, right? Especially if there's a sponsor involved. So these are all the things that you need to be aware of, that you need to build into your worst case scenario. Mm-hmm. If X, Y, Z, every single one of these bad things happen, what is that pool of value that I actually have that I can claim on? And how senior am I in that waterfall to be able to claim, right? And so that was really interesting in from the sense that, like, this is a valuation exercise. This is also an exercise in understanding legalese. What I wanted to really get a better handle on, because at the time I had never been through a process, never been through a bankruptcy process, right? And those things get really messy.
Yeah.
That became later, my subsequent role, I was able to get more experience there. But at the time, that was the progression of the analysis that needed to be done. And it didn't happen overnight. These were things that
weeks. You're
right. Takes weeks. You have the model build initially. You understand the drivers. Countless number of calls with like sell side analysts, with buy side analysts. There's a lot of education that goes on because people will have very different views from you. They'll ask you for your view in return. It's like a quid pro quo type of way. They'll give you your view only if you offer something valuable to them too, right? So, but for them, it's another data point in terms of how the general market is thinking about this thing. So, yeah. So then you get a very, very good sense of like, okay, this is my view, but I also need to understand, in the event of an event, or if there's an earnings report, what is everybody else expecting?
Yeah.
Then that's going to dictate how that security or that instrument trades on that news. So again, I benefited from all these. I'm like a Frankenstein's monster, all these patched up different parts from all these different roles.
Yeah, I'm thinking like the background you had was probably a really good one for being an actual investor. at a hedge fund. So yeah.
I would say so. I mean, I'm thankful for that. I would say a lot of folks sometimes have, especially at large shops, they will be like the analyst for a name or a situation or an industry, and all you focus on are just the numbers. And you have like internal counsel or legal team to be like, okay, just look at that. Go look at what holes there are in this document. Tell me where I can get hurt. I think that's nice. I mean, but if you don't have lawyers at your disposal, or you don't have counsel on retainer, you need to be able to do this stuff quickly, right? Yeah. So it was definitely a very, very helpful skill to learn along the way.
So you're there for a couple of years as this kind of distressed role, high yield role, and
yep.
What was it like? Was it a roller coaster? You did really well. You didn't do well. What happened?
Well, I did well. I was a top P&L generator. First year, I think second year too. Some cool trades that we did. Again, it was a very flexible mandate. So, we looked at credit, long, short. We looked at equity, long, shorts. We looked at hedges. We looked at cap arbs. We also did merger arb as well. It's something I had never had any experience with, but there's John Paulson and like all these big guys, they made their careers on like merger arb, right? And so that was something that was so cool. I was like, man, this is awesome. Like, I'm not only am I working in a product or a space that I'm, I get a lot of excitement from, but it's like I'm also looking at equities for the first time. I'm also
you're looking at a bunch of stuff. Sounds cool. But why leave?
They just didn't raise money. It was hard. It's hard to. I mean, I love the team. I really love the team.
Yeah,
like, it was such a solid group of guys, but I mean, at the risk of shooting myself in the foot, I mean, I'm a survivor. I want to go where I can best perform, have the best resources available, and I want success for myself as well, right? And to help people around me.
And so, when you say they weren't able to raise money, I mean, they had money, right? You're trading, and so like, why not just continue? And like, you're doing really well in the P&L. So like, what do you mean they weren't able to raise more, like a bigger fund or something like that?
Yeah, I mean, the AUM was not.
It wasn't huge. Yeah. Okay.
It wasn't scaling as I wanted, and it's hard to run a credit platform.
Yeah.
And a distressed platform if you choose to invest in those products with. I mean, I still believe it's hard to run any type of credit platform if you're under $1 billion.
Yeah.
I mean, you can get away with it maybe at 500 or 750.
Why is that? You can't play in enough names or something,
It's just you don't have enough scale sometimes to take big positions, right? Because of distress, you need to be able to, if you want to make 2, 3x, 4x, 5x your money. I mean, sometimes I can get to this later, but like sometimes you need to be able to take entire tranches down, or you need to be able to have capital to deploy really quickly.
Yeah.
You also, I mean, larger firms with big AUMs, they get the first look at a lot of these opportunities, right? Whether it's from a primary perspective or from a secondary perspective, right?
Yeah.
Like cap markets head at UBS is not going to know small fund ABC with 25 million. Again, I'm not saying this was the AUM at the time. I'm just exaggerating.
25
million AUM. Like you're not. That's like I think that's like BlackRock's minimum size. Like for primary issuance, like they need to have at least 25 or 50 million bucks, right? So it's hard to run a platform because you get overlooked on the primary side sometimes because your order size is just not big enough,
right?
Or you're like what sell side banks really want is for you to trade with them, right? And so for a small shop, you're getting just death by 1,000 because you're getting killed on bid-ask spreads over and over again, right? And you can't make a lot of that money back if you're trading that often. Again, I mean, maybe I'm confounding some factors here, but there are shops that are very trading oriented, like a Millennium, or Exodus, and then there are like the buy and holds, like very activist plays, like the Elliots of the group, right?
Yeah.
So, like, point being, I think the writing on the wall right now, especially with regulation, with administration in terms of oversight, is that it's a land grab in terms of assets. You saw 2 years ago there were people buying up trading brokerages like TD Securities. I think it was TD Securities, or Ameritrade, I think.
Yeah.
People are looking to buy clients, and they're doing so through buying AUM, right? And so funds that have the largest amount of AUM can command the largest positions. They can take bets that don't require you to circle outside capital, right? You can just do it yourself. You can also be the anchor order and build that relationship with sell side banks, right? And it's just there are things that are benefits that come with like scale and size, right?
Yeah.
But that's why I left. So
that's why you left. You said, this isn't, we're getting kind of death by a thousand cuts, like you said, even though you're having good ideas and
it was fun.
Even on the right side of a lot of these trades, you're still thinking like, wow, we're rowing upstream here without the scale. So what did you take? You didn't take a break this time. So what was the thought process? I'm going to do something myself. I'm going to go partner with other people. What was the thought process?
Well, so the next shop, I joined because I was, to put it simply, I was going to be given a lot of ownership in my positions. I was able to just be very senior and come up with the ideas, underwrite, and the economics were just a lot better.
Yeah.
It was.
You talk about not necessarily how much you were making, but like the economics of like being, the amount of care you get at like as like a junior person, and then like how it can just change dramatically.
Yeah. So my understanding, and again, some people are very hesitant to say, so I'm not very sure about what it's like at other firms, but from my understanding, by this point I was like a senior analyst level analyst, and typically speaking, at large, it depends on where you are and the culture, right? So, if you're at an Apollo or you're at a TPG, unless you're like an MD or you're an actual partner, you're most likely not going to get carried, right?
Yeah.
As a senior analyst, you could potentially be grooming yourself, or they could be grooming you for PM role, right? Because you have covered many different sectors in the past. You've demonstrated and excelled in an ability to be able to manage risk and understand credit analysis. You have an experience for appreciating macro and how that drives your sector, right? That's the pathway from a senior analyst to a PM role, right?
Right.
And so PMs, partners, usually at firms, they usually will get some amount of points. My understanding is, depending on where you are, it's anywhere from 1 to 5 points, right? 1 to 5%, but 5% is a lot, right?
Yeah.
5%. I can't imagine if you're at, TPG, you're getting like 5 or 10 points, right? Like
there's too many partners.
There are too many partners or a lot of mouths to feed. You're probably getting half a point or quarter of a point or something. I'm guessing at this point.
Yeah.
But that's part of the appeal of joining a smaller shop, is that you get in at the ground floor, you actually build.
And there you're getting like what, 10 points?
Some places can give you 10 points. Some other places give you 5 points. Again,
maybe because you're not the founding, necessarily the founding, but they're bringing you in as a partner level. They're kind of still keeping most of the carry themselves, probably. But yes.
Yeah. I mean, partners will keep no less than 75 to 80% of the economics, right? Like, and it also depends on, whether you take seed funding. So if you get seed funding, then they'll ask for, 2 to 3 points here and there. And then you have, other investors that probably want ownership. And if you're desperate to raise money, then they could extract their pound of flesh in the form of points as well. But I mean, 10 points, as at a small place, I don't know. I mean, that seems pretty high to me. I mean,
yeah.
I would say probably,
you would know better than I would.
I would say like 2 to 5 points is, if you were to get points, that's probably what you would be given.
And that's if they're bringing you at like the partner level or even director level or something like that. Yeah.
Correct. And at this most recent place, I was promoted to partner and I had an economic stake in it. And so what was cool about the setup here is, on top of the actual points that you got, for any sidecar or any co-investments, you had a claim on the P&L there as well, right? Like a sizable portion. So you can claim up to like X percentage of the P&L that you made. So let's just say a position made you, netted you $10 million post fees, right? You could get X percentage of that P&L. Can
you share what your best year was, either at the previous place or this year? You can give a range. Or
I'll just say it's
multiple seven figures.
Yeah, it's multiples of my base salary. Yeah.
Okay. Thank you.
But again, this is not something I want to make it clear that this is not something that people should expect when they join a fund, right?
Listeners just kill me if I don't ask. They always are like, "Why didn't you ask me what you made?"
Yeah. I mean, PMs at large shops will make 5 million up, right? Like upwards of $3 to $5 million. And for senior analysts or MDs, you can very easily see yourself over $1 million, right?
Yeah.
Depending on the shop, but there are places where, as a senior analyst or as a principal or MD, your all-ins, I don't know, 750 to $1 million probably.
Yeah.
I think the market right now is probably more 500 to 750 for senior analyst roles. So, but I would say people shouldn't expect points, and you kind of have to read the room a little bit. Do your research, talk to other people at the firm who are senior. Don't go in there with a bazooka and demand like you want 5 points, right? Like understand, you should present an argument, but ultimately it's up to the firm, right? So, but yeah, I mean, I would say that is a very important question that you should definitely ask. Do not feel shy about asking it, and tell them usually what you expect. In fact, I think most places, when they ask you for your salary, you're not supposed to tell them, especially if you're in New York State. So you can give them a sense of like a way that I like to get around giving my number is I ask them what the market rate is, right?
Yeah.
Have them validate it. And then I'll just say, okay, that seems fair and reasonable, rather than telling them what I got paid. So for folks who are interviewing out there, you can ask and put them on the spot, right? They can't triple dare you again, right? Like you double dare them and stop there, have them answer the question. And that gives you a sense of okay, this is where the market is. This seems about fair.
Yeah. And so do you typically if they come in a little low or a little light, would you suggest kind of coming in a little higher and say, well, I was thinking more around this range?
Yeah. I mean, I could, it depends on who I'm talking to.
Yeah, because you've jumped enough places now that you've had to have this conversation several times.
Yeah, I've had this conversation enough times to have a sense of what the street is paying.
Yeah.
So, if they were to, communicate a number that was a little lower than expected, I'm not going to outright reject it. I'll just say, okay, that's interesting. I've heard from other places that the all-in comp last year for X, Y, and Z shop for this senior level was this, right?
Right.
Is there a reason is there backloaded pay, or you just have to kind of put in your first year? I try to make it a more of a dialogue, rather than be this is bad, right? So I try to make them feel comfortable in that awkwardness. So.
Well, I've been holding you for a long time. So I just want to say, first off, thank you for sharing your story. Super interesting. And obviously very knowledgeable, obviously you've had a very long and successful career.
Thank you.
Hopefully it'll keep going.
No, absolutely.
And I just wanted to say, just give you an opportunity before we call the pod, just any other kind of final words of wisdom, kind of looking back at your career, with all the twists and turns so far.
What I would tell myself, 10 years ago.
Yeah.
And buy Bitcoin before it was over $100,
Yeah.
So,
that's easy. That's an easy one. Yeah.
That's an easy one, but I'm kind of half joking. We're not half joking.
I mean, you hit on it earlier with networking, but anything else slightly less obvious?
I would tell myself, I would say, start to develop your gut feeling and start to trust yourself. Obviously, there has to be a basis in that, but I found a lot of decisions I've made along the way have been, listening to my gut, right? And I've always ended up in a place that was better than where I was before. And it's a function of me having a very clear sense of where I want to be and the home I want to create for myself. So invest in that sense of that gut feeling that you have, and learn to trust it, because you're going to need it when you're trading and when you're working in that type of role. I mean, the last thing I would say is look, if you have money, start investing young, start to experiment with money, understand how the market trades. You're going to lose some money, but it's better that you start out with a small pile than lose, $400 million for a trade at a hedge fund. So not what I did, but learn to invest quickly and young, and then buy Bitcoin under $100.
That one there. Well, thanks so much for your time.
And thanks to you, my listeners at Wall Street Oasis. If you have any suggestions whatsoever, please don't hesitate to send them my way, Patrick at wallstreetoasis.com. Until next time.